Okay, well, we'll go ahead and call the meeting to order. This is our June 21st Pension Committee meeting. I'd like to welcome Jennifer Brown as our newest employee designee here. She's replacing Melissa Wright. Jennifer is the city's finance director. I believe will be a great addition to our committee, so welcome.
Hi, Jennifer.
And I believe this is also Mr. Maxwell's first meeting with the Pension Committee, so welcome to you as well, Mr. Maxwell. So our first order of business is to consider minutes of the April 19th meeting. You should have received corrected minutes from Frida earlier this week. Are there any questions or changes to the minutes? If not, is there a motion to approve?
Yes, so moved.
Is there a second?
Second.
Okay, all those in favor?
Aye.
Aye. Any opposed? Okay, next we have Natalka with Fiducian Advisors to review the April and May plan information and rebalancing recommendations. Good morning, Natalka.
Good morning, everyone, and thank you for having us participate in the meeting. Today, I also have my associate, Chris Rollins, on the phone, and he'll be reviewing some fiscal year-to-date updates for the plan when I go through, after I go through the April and May flash report with you. And welcome to the new committee members. I know Jennifer, but I haven't had the pleasure of meeting Mr. Maxwell in person yet, but look forward to working with you. Okay, so if we turn the clock back to April, I'll sort of go through a little bit of just market background as well as plan performance with the flash report. So if you have your April flash report in front of you in your packets, you can follow along on the table, follow along with my comments. From a performance standpoint, April was a rather muted month for returns in the broad market indices. It was a slightly positive month for both equities and fixed income. On the fixed income front, interest rates did not change much during the month of April. We finished the first quarter with the 10-year bond at 3.47%, and at the end of April it was at 3.44. So relatively stable month from an interest rate standpoint. Excuse me. A number of investment trends in the first quarter, from the first quarter, continued in April. Longer duration bonds outperformed shorter duration bonds. Credit bonds outperformed treasuries. International developed markets outpaced U.S. equity markets. And commodities continued to struggle in the month of April. Within U.S. equities, one of the things that we saw in the first quarter was a rotation away from the value style and into growth. In April, we saw that reverse for a short period of time where the value style actually outpaced growth in all but small cap. From an asset standpoint, the city's plan assets rose modestly in the month of April from $161 million in assets to $162 million in assets. From an asset allocation standpoint, the plan continues to be overweight your strategic allocation to total equities, meaning domestic equity, global equity, and international equity. Your target is 42%, and your plan ended the month of April at about 48.5%. So overweight all segments of equities except for emerging markets, which were a little bit below their target because emerging markets had a pretty tough year last year. You have a 23% allocation in your plan to real assets That includes global REITs, U.S. REITs, and natural resources. And you are slightly underweight that 23% target at 21.6%. And that underweight is across both REITs and natural resources, split pretty evenly. Your fixed income allocation is also underweight target. Your target is to be 34% in fixed income, and you were at 28.3% at the end of April. All of the segments that you're invested in within fixed income, you have core bond managers, a high-yield bond manager, and a multi-sector bond manager. All were slightly underweight their targets at the end of April. For those of you that attended the first quarter meeting, you'll know that we discussed taking a look at the plan's asset allocation, and in light of the correction that occurred last year in 2022 in fixed income markets, we're taking a look at reducing the plan's exposure to equities and potentially increasing the fixed income exposure to de-risk the portfolio a bit. The last 10 years within the fixed income markets, we've had to sort of go to different segments of the bond market in a search for yield when we've been, during a period of zero interest rate environment. And with last year's correction, as painful as that period and process was, fixed income is now doing what it's supposed to do in a portfolio and providing yield, and that's including high-quality fixed income. So we're going to take a look at the opportunity of de-risking your fixed income portfolio by increasing the weight to fixed income and also rotating the fixed income portfolio into higher quality fixed income. So trimming some of your high yield and your multi-sector bond exposure into higher quality fixed income. So we're conducting a search for a high-quality core bond manager, and to sit alongside and become part of your fixed income team. And Chris will touch on that a little bit later when he goes through some of the fiscal year update and how that might dovetail in from a timing standpoint. But during the month of April, there were very minor rebalancing recommendations. We do take an opportunity on a monthly basis to see if anything could be trimmed or added to. And in the month of April, we recommended trimming some overweight large cap and international equities on strength and rebuilding your operational cash account. Your operational cash account is where you pay benefit payments and other plan expenses from. You have a 1% target allocation to operational cash. We have been recommending the past 2 to 3 years, as we've gone through a very volatile period in the market, that you keep 6 months or over exposure in operational cash to comfortably accommodate all your benefit payments and plan expenses. So we periodically rebuild that operational cash account. That recommendation was approved and executed at the beginning of May. Any questions on April before I quickly touch on the May flash report?
I don't see any.
Okay, very good. Well, the month of May was unfortunately a red ink month across all asset classes except growth indices across all capitalization ranges. And by red ink month, I do mean that both stocks, bonds, and real assets had a negative return in the month of May. As I mentioned, the growth asset class was an exception there. There are 5 to 10 stocks driving the a large cap and growth indices. Once again this year, I feel like we're seeing a little bit of a repeat of the fan mag, and when we had the before the pandemic, 4 or 5 mega cap stocks driving the growth of the stock indices. And once again, names like NVIDIA, Meta, Apple were generating very strong returns, whereas much of the broader market was flat to negative. Only 3 of 11 sectors in the S&P 500 posted positive returns in May. And those 3 sectors were all growth related. Technology was up almost 10%, communication services was up 6%, and consumer discretionary was up 3%. The worst performing sectors were your value-oriented sectors of energy, which was down 11%, materials down 7%, consumer staples and utilities both down 6%. And the large financial sector was down 4.3%. So a very bifurcated market being driven by the growth sector. Both developed and emerging markets also finished in negative territory, and developed markets sort of ceded their leadership role to U.S. stocks during the month of May. Bonds also posted a negative return. Interest rates rose across the yield curve. I mentioned earlier that the 10-year bond finished April at 3.44%. It finished May at 3.61%. And there were periods it was higher than that during the month, but at the end of the month it quote unquote came back to 3.1 or 3.6%. Longer duration bonds fell more than shorter duration bonds. From a real asset standpoint, both domestic and global REITs fell in line with the value sectors and the financial sectors of the equity market, and commodities and natural resources were the weakest sector, dropping 8.6%. So during the month of May, the plan's defined benefit plan assets retreated from $162 million to $158 million in assets. The growth managers that you have on your team, and your global equity managers and your fixed income managers, were the most defensive during the month of May and fell the least. Some of them actually didn't fall at all. They sort of maintained their market value. And your value-oriented managers, your real asset managers, were the weakest performers. So very much in line with the index. Your strategic asset allocation really did not change very much. You're still overweight equities, 48% versus your 42% target. And you're still underweight in fixed income, 29% versus 34%, and also underweight in real assets, 21 versus 23%. So we did not have any rebalancing recommendations for the month of May. Your operational cash levels still have more than 6 months of liquidity to meet plan expenses, and we are sort of waiting for the review of the core bond search to do further rebalancing and sort of rebuilding, or if you will, making an update to your strategic asset allocation. So does anyone have any questions on the May flash report or any of our recommendations so far? Okay, I'm going to turn it over to Chris to provide you with a little bit of an update on fiscal year-to-date performance of the plan, and any comments he might want to add on the upcoming bond search that we're doing. Chris?
Yeah, thanks, Natalka, and good morning, everybody, and welcome new committee members. As Natalka provided sort of an overview of capital market performance, one of the numbers the committee is always cognizant of is the fiscal year number. That's the number that goes in the books. So your fiscal year number ends June 30th, so we want to monitor that number. And despite, I think, all the headline risks that we've seen, whether it was the debt ceiling negotiations and the failing of some of the regional banks earlier in the first quarter, and 10 interest rate hikes by the Fed since March of 2022. The plan's fiscal year-to-date number, the return through May, it was about 7.6%, and so that's a pretty good number. If you look at your discount rate, the objective of hitting that discount rate, and that doesn't take into consideration really kind of the strong month we're having here in June. So at the end of May, you're at about 7.6%, and here in June, we had the S&P up about 5.5%. International markets are up anywhere from 6 to 7%. REITs are up about 5%, and fixed income's relatively flat. So if you take into the kind of the consideration of June numbers, and we're about 9 days away from the end of the fiscal year, hopefully, you can put a good number in the books for this fiscal year. Natalka talked about sort of the kind of a different landscape for fixed income, and it really is a significant change than what we've experienced over the last decade. So over the last decade, as you know, interest rates have hovered at historic lows. That's a byproduct of Fed policy to stimulate the economy over the last decade. But the challenge for asset allocation settings like Murfreesboro and other municipal plans is that you had to kind of take a little bit more risk in the fixed income portfolio in order to really kind of hit that discount rate objective. But the restoration of higher yields today as we speak, right, as I mentioned, the Fed moved rates up about 10 times since March of 2022 to the tune of about 500 basis points or 5%. So that's a different ballgame right now. So the restoration of higher yields is influencing our thinking two ways. One is how does fixed income play in the overall portfolio, given that we have much higher yields? So as Natalka pointed out, fixed income is designed to provide that ballast within the portfolio to reduce some of the risk that equities deliver. So I think what we can look at is potentially on a go-forward basis is maybe a higher allocation of fixed income because we have higher return expectations given higher yields. And then within the fixed income portfolio, given the restoration of higher yields, can we kind of de-risk a little bit? What I mean by de-risking is can we improve the overall credit quality? Now the credit quality is very strong, but can we take a little bit of risk off the table and introduce a core manager that is more tethered to sort of, I would say, high quality issues? And I think that's a little important as you get a little bit into sort of this economic cycle that we're in. Even though the economy has been resilient, if we see tighter lending standards and weaker corporate earnings, that could influence or have an impact on higher default rates for those less credit worthiness fixed income allocation. So I think our thinking is there's really not an appetite or a need to take on credit risk in the fixed income portfolio to the levels that we've experienced over the past decade, which is a good thing. And then on a go-forward basis, as we re-underwrite the portfolio ongoing is, what is the overall allocation to fixed income, given the higher return expectations and the restoration of higher yields. So I think these are good things on a go-forward basis, even though last year's bond market carnage, the silver lining is higher yields are going to benefit this plan on a go-forward basis, and will serve to reduce the volatility of return expectations, because you'll, I think, gradually, through a disciplined, judiciously dollar cost averaging strategy, kind of de-risk this portfolio over time and more into fixed income. So that's a little bit of a takeaway. One is the good news on the fiscal year-to-date return through May was at about 7.6. I think looking at June's performance, it's safe to assume that I think that number's higher. Hopefully we could finish on a good note. And then on a go-forward basis, we will be looking at a high-quality core bond manager. The thinking along the lines is to de-risk a little bit away from credit and ultimately increase the allocation of fixed income and de-risk a little bit from equities.
Well, I like de-risking, so that sounds good to me.
Yeah.
Yep, so, we've provided Erin with some information, and we're, in upcoming meetings, perhaps with the second quarter performance, if you would like to, review some information on core bond managers, that would be great. I would just make, sort of two comments that, we are looking at initially adding to your team and not sort of replacing fully the high yield or multi-sector bond manager. Both of those managers have done a very good job for the plan and continue to do a very good job this year. So far, on a year-to-date basis, credit and high yield and other spread products like mortgage-backed securities, asset-backed securities that you would find in a multi-sector bond fund have done very well, and your managers have participated. So it's always good, I think, to rebalance and make these types of changes in asset allocation from a position of strength. So you'll have the ability to trim those managers on strength, and we think that that's a good thing.
Absolutely. Yeah, we'll definitely look forward to that at our that discussion at our next meeting. I think it'd be good to. I've spoken with Frida about distributing the information to the committee that you shared with me earlier this week, and then we'll have that be a focus at our next committee meeting.
Terrific.
So at this time, you said there'll be no rebalancing recommendations until we do that core bond search. So did anybody have any questions for Nataka or Chris about their presentation? Okay, well, thank y'all both for your update this morning.
Well, thank you for making the time on the agenda, and let us know if you need anything from us, Erin.
Absolutely, thank you.
Thanks. Bye, everyone. Have a good summer.
Thank you.
You too.
Bye, everyone.
Okay, so our next item is we have a recommendation from Ms. Brown to consider a couple of contracts with Cowden and Associates for actuarial services. This is moving the city's pension plan away from the USI actuarial firm to Cowden and Associates. One of the contracts is for fiscal year ending June 30th of this year, and the other is for next fiscal year, correct? Okay. The contracts include both the city and the MED pension services, but the committee will only be approving the city services today. Jennifer, did you have anything that you wanted to share or add to that?
Just that we decided to reach out to Cowden and go with them because of work we've done with them on previous engagements, especially with the MED pension plan as we were working to terminate that plan and as we went through the sale of the MED. Cowden did a great job in everything they've done with us on those previous engagements, and with the changes at USI, we thought this was a good time to have the plans looked at, or have the city pension plan looked at by a different actuary.
Are there any questions about these contracts?
Is there any increase in the cost versus the previous vendor?
For this fiscal year, there's actually a significant decrease in the cost.
Okay.
For next fiscal year, there is a $5,000 increase in the cost, but with that, the scope of services includes some updates to the tables and other actuary methodology that is included within the scope of services that USI was going to charge extra for and only did every 5 years.
Okay.
Is there a motion to
So
approve?
you need a motion to approve what, both or one, or?
You can do one motion to approve both.
Okay. So moved.
Second.
Okay, all those in favor?
Aye.
Aye. Any opposed? Okay. Is there any other business to come before the committee?
I have a question. I have a hard time understanding because I have hearing aids with, especially the men. But what was their suggestion on the core bond? To add bond fund managers, or are they looking to change some bond fund managers?
They're going to add, they'd like to add a couple of core bond managers.
Okay.
So there's some information that'll be sent out to y'all probably
Okay.
later today
Okay.
about that search. And then we'll go through that in more detail at the next meeting. And I'll also reach out to Chris and Natalka and see, this was Chris's first time presenting over the phone with us, and sometimes it is difficult to hear over the
Yeah.
speaker system in
Okay.
here, so I'll talk to him about that as well.
The only question I would have, and this is probably more of an Earl or Aaron question, is if we're overweight, 48 versus 42%, when is the time to do that?
I believe the target is when we're taking on this new core bond manager, is where we're going to start kind of shifting towards getting back aligned, is Natalka's goal there.
Yeah, only reason I bring that up is it seems like the market always reacts to the Fed, and they press pause for now, but who's not to say that they do
I mean,
another?
I would raise the issue with them the next time. Where are we? Because the Fed's not finished. We don't want to be buying the bonds before they finish.
Yeah.
If we can keep from it, because that just cost us.
Yeah.
But,
You're saying buy them before they're finished?
no,
Buy them after.
Buy them after.
you always want to try buy your bonds if you're looking for now, if they're strictly looking for yield, okay, you buy them anytime, but you'll see your value go down as they raise rates. Now that value will come up when they start lowering yields again. But I don't think they're finished, so I'd kind of cautiously do that, and we'll see what they say about that.
I appreciate your input there, thank you.
Yeah.
One item I would like the committee to consider, with Ms. Wright rolling off, she did serve as the vice chair. I would recommend Ms. Brown be considered as the vice chair for the committee. We ran into a situation a couple of years ago where I was unable to attend a couple of meetings, and that caused an issue where we did not have a vice chair, so I think it's a very good practice for us to have that in place. So, does anybody have any concerns, or can I get anybody to recommend
I'll
that?
make a motion that we
Why not?
elect Jennifer.
Okay.
Second.
All right.
Do you
All
need
the-
a motion or anything?
Kathy just made the motion,
okay.
and Mr. Maxwell seconded. So all
Second.
those in favor?
Aye.
Any opposed?
Jennifer's not opposed?
No. Okay, is there any other business to come before the committee? If not, we'll go ahead and adjourn. Thank you all.
Thank you.